Good afternoon and welcome to the Maine Community Foundation's Investment Program 2023 review. My name is Leanna Kingsbury. I'm Senior Director of our nonprofit agency funds, and we're excited to have many of our donor advisors, agency fund holders, and other community partners joining us here today. Our presenters will be two members from our management team. Becca Ichiregi is our Vice President of Donor Engagement, and will be talking with us a little bit about what working with donors means and how her first year at the Community Foundation has been going. And then the bulk of our program will be with Brendon Reay, who many of you have met. Brendon's been at the Community Foundation for 2 years and is our Chief Investment Officer. He will walk us through how the investment portfolio did in 2023, as well as the outlook for 2024. So just briefly, a couple housekeeping items. Excuse me, let me get this going there. The call is being recorded today, so certainly if you'd like to come back and refer to things, you'll have the opportunity to do that, as well as share it with others. We would ask that if you have any questions during the call, please use the Q&A feature of chat. Of Zoom. We've disabled chat, but I will keep an eye on the Q&A, so use that as questions come to mind. And certainly after the call, or if you are looking at the recording, please feel free to email any of us. Our email addresses for myself, Brendon, and Becca are here, and you can reach out anytime with questions. So with that, I'm going to turn things over to Becca.
Thanks, Leanna. I'm Becca Ichiregi, and I'm the Vice President of Donor Engagement here at the Foundation. My role is to welcome you and set the stage a bit for my friend Brendon Reay, our Chief Investment Officer. This is the first of a series of donor education opportunities we're hosting over the coming months. More information can be found on our donor portal. On the call, as Leanna said, we have fund holders, nonprofits whose endowments are invested with us, as well as foundation and staff volunteer leadership. Welcome all. I'm a Mainer who was living in exile for about 30 years, raising a family and building a career in nonprofits in the greater Boston area. My family and I returned home to Maine a few years ago, and I couldn't be more thrilled to be with you here today. What does someone in charge of donor engagement do? Well, fundamentally, my team and I work to ensure that our fund holders have a smooth, effective grant-making experience. That through our relationship, you feel aware of some of the issues facing Mainers today, and that through your awareness, you see a role for you and for us together to help solve some of those issues. Mostly, I hope you see value in your relationship with us, whether as a nonprofit partner or a fund holder. Increasingly, however, fund holders are asking us to create more of a donor community. From my position at the Foundation, my team and I have a bird's eye view of all of your grant making, and I see where you have energy, where your passions are. Is there an opportunity to connect you to one another, to learn from one another, and to see how your generosity, when leveraged together, makes an even bigger difference? Some might even call it collective impact. Because your philanthropic dollars, whether individual gifts or nonprofit endowments, when combined with others, yield greater results for Maine. One of the areas we're creating a community of fund holders around is equity. We're partnering with a small but mighty group of donors to explore how to best leverage philanthropy to further achieve equity here in Maine. Together, we'll look at things like what practices enable equitable grant making and what are some of the most pressing issues today here in Maine. That really is one of the best parts about being a member of the Maine Community Foundation team. We are able to take stock of what's needed in our community, and then we work together with members of our community to address those needs. Because at the heart of it, a community foundation like ours was created so that the cumulative effect of individual giving could benefit, well, communities. After all, we are for, of, and by our Maine community, and we have been for more than 40 years. So what does 2024 and beyond look like for the Foundation? All of the work you're currently familiar with, our grant programs designed to address emerging needs, our work with you as fund holders and nonprofits, and our values-driven approach to philanthropy. Increasingly, you'll see us take a role in helping to make housing more accessible, our workforce more work-ready, and ensuring that the natural beauty of Maine is preserved for generations to come. All of that and judicious management of your philanthropic dollars, which leads me to the main event and why you're all here, to hear a report from our Chief Investment Officer, Brendon Reay, on our portfolio's performance last year. So with that, it's my pleasure to introduce you to my colleague and my friend, Brendon. Brendon?
Thank you, Becca. I'm sure that many, if not most of you, have worked with Becca already. It's just so spectacular. She's been here for about 8 months now, and just what a terrific colleague, and what a tough act to follow. So thank you very much, Becca. Leanna, can you cut to the next slide, please? Thank you. Quick agenda for what we're going to do today. I tend to think of these things in terms of questions. I don't know if that's my academic background or not, but the first one is, so what's the purpose? What's the point? What happened? How did we do? How are we invested? And what else are we doing? So without further ado, let's go to the next slide. So this slide shows the growth of Maine Community Foundation assets since inception in 1983. In fact, over there on the far left, there's almost nothing there. It was pretty small. And you can see how the foundation has grown. The blue part of each of those bars shows the net cash flow at the foundation. That's the gifts that have come in, the grants that have gone out, and the operating expenses. So gifts minus grants minus operating expenses. That's the blue part of the bar. The orange, or the brick colored part of the bar, shows the cumulative investment return over that period of time. And you can see that, especially in about the last 15 years, it has been supercharged. It has just been terrific. Now, the point of this slide is not to say, look how big we are, but it's to emphasize what is on the next slide. And that is to say that the investment return, what's the purpose? The investment returns contribute to our collective effort. That's the point, right? To have an impact on Maine. The growth of our assets enhances your mission-specific goals. I'm thinking here of our agency fund partners in particular, and it magnifies your charitable impact. And I'm thinking of especially of our donor advisors. And lastly, the growth of assets underwrites MaineCF's operations. Your administrative fees, that's our operating budget. That's how we run everything. That's how we do everything. So this is another shorthanded way of saying thank you very much. It's your partnership literally keeps everything going and enables us to do the many things that we do on your behalf. Next slide, please. This is not directly connected to the investment portfolio, but one of the many things, very sadly, that we did last year was in response to the tragic events in Lewiston in late October. Almost immediately after that, we spun up a response fund called the Lewiston-Auburn Area Response Fund. It was in the news quite a bit yesterday because yesterday was the last day for contributions to go in. More than $5 million in contributions have come in from all around the world. We process all that, credit cards, checks, all the different ways that literally jars of pennies came in from schools. It was a remarkable thing. And I think that number is going to be significantly more than 5 million by the time we get done doing all the counting. And 100% of this fund is going to the victims, to the families, the survivors, and the nonprofits who will help in the recovery process. Again, it's your partnership that makes it possible for us to do something, again, incredibly sad, but something like this to make this possible. So again, thank you very much for your partnership. Let's go to, let's get into the investment proper. So what happened in 2023? That's what this slide shows. There's a lot of gobbledygook and jargon here, but the key thing to recognize is just about everything in the investment world went up last year. And that was really a dramatic turnaround from 2022 when just about everything went the other direction, went down. So in 2023, the S&P 500, that's usually considered kind of the bell cow of the U.S. equity market, was up about 26%. And you can see these other, the MSCI ACWI, the All Country World Index, up about 22. And the bond market, the Bloomberg Ag, was up around 5.5%. So really everything everything made money last year. Good for us. And Q4 was a remarkable quarter. Q4, I might be off by just a smidge here, but Q4 was one of the top 20 quarters in the last 50 or 60 years. It was a remarkable rally at the end of the year in both November and December. So that's the highlight there. Let's just a quick reminder about what exactly is the primary pool, which is what we're talking about, which is everyone is in the primary pool. That's our large bucket of money. It is an institutional, global, multi-asset, all-weather portfolio. Our goal is to return 5% or more. Love to always more net of inflation. At the same time, we are looking to minimize risk, which we think of as volatility, and we're looking to maximize return. So we're looking to use those two things, those two levers together. They work together. We are focused on sustainable or responsible investing. We have a statement of responsible investing, and the acronyms that typically are involved in that conversation are ESG, which stands for environmental, social, and governance factors, and DEI, which stands for diversity, equity, and inclusion. And new this year, and I'll talk about it later, is that we are actually doing investments right here in the state of Maine, putting money in the ground here in Maine. So how do we do? Let's get to the numbers. For the 1 year, total portfolio, 12.9%. The benchmark, 15.42%. Hold on to that because I'll talk about that discrepancy. So we were up 12.9, the benchmark up 15.4. A portfolio, a 60-40 portfolio of stocks and bonds, a very kind of typical asset allocation. So we like to show that here to give people a feel for what that would look like. It was up about 15.4%, kind of right in line, just a smidge below our benchmark. How did the rest of our colleagues do in the endowment and foundation world? Not just community foundations, but endowments and foundations. This is a third-party collection of data of endowments and foundations between 250 million and 1 billion. To put that in context, we're right around 700 million. The primary pool, 690 or so at the end of 2023. So that's kind of our neighborhood, if you will. That collection of endowments and foundations was up about 13%, 12.96. And then it shows the rank here at the bottom. That's the percentile rank. Where did we fall in that mix? And for last year, it would be hard to get any more in the middle. We are smack dab in the middle in the 51st percentile. Not really hitting for power, definitely hitting for average, and that's where we wound up. Now, the rest of the chart shows you the longer term numbers, 3, 5, 10, and 20 years, and then since inception. And you can see at the bottom there that also compares us to that same endowment and foundation universe. So you can see the ranking of how we've stacked up. Since inception, since 1993, we come in right in at, call it the 20th percentile, 19th, 20th percentile. So top quartile performance in our neighborhood, if you will, over the last 30 years. Just a little shy of 7.9%, beating the benchmark by 82 basis points over time since all that time. And I put these longer term numbers up there because it's going to be very important for us to always be situated in the near term inside of the long term. That's going to be one of the key takeaways here. So there are the data. Now let's show it in a picture. Speaks I don't know if it's more than 1,000 words, but sometimes it's a little bit different view. The primary pool is that brick colored bar on the left in these collections. The middle bar, that navy blue bar, that's our policy benchmark. That's our benchmark. And then the light blue bar is the 60-40, the MSCI ACWI, the All Country Stock Index, also combined with the Bloomberg AG. Again, just a very standard bond index. As you can see, in 2023, we lagged both of those by about 2.5%. Is what it comes down to. And then you can see the 3, 5, 7, et cetera, data and how that trails out over time. So over time, over the long haul, handily beating our benchmarks, handily beating a 60-40 portfolio, and last year lagging a little bit. So let's look at how we stacked up against the neighborhood, so to speak. This slide shows again the last year and going out 20 years in two different third-party collections of data. The first one is the same one we saw earlier, the investment metrics, endowment, and foundation universe. That's the middle bar, the navy blue bar. And the other one is one that we haven't looked at yet. It's from a firm called Crucial, and they do a survey of FOG is the Finance and Operations Group. It's a collection of folks, and they do this survey of $500 million and up. Now that's just community foundations. That's what that light blue bar is. And again, you can see in 2023, we didn't exactly distinguish ourselves. And then over 3, 5, 7, et cetera, we certainly have distinguished ourselves much more dramatically. So 2023 in absolute terms, great. We made money. It was a good year, up 12.9%. On a relative basis, a little bit less exciting. Next slide, please, Leanna. Let's talk about exactly why that happened. So that's the elephant in the room. So great, we made money. We're up almost 13%. Boo hiss, we're underperforming our benchmark. And so here are the data again for you to see. On the left side column, that's the 1-year mark. There we are, total portfolio up 12.9, policy benchmark up 15.4, so 2.5 percentage points of underperformance of the benchmark. And then what I did underneath that is I showed the returns of some different I segregated different components of the portfolio out. So you can see our U.S. public equity sleeve or bucket, if you will, was up about 31%. Keep in mind the S&P 500 was up about 20, a little less than 27. So we're shining brightly on U.S. public equity. Terrific. The non-U.S. public equity part of the book up about 19% and a little bit of change after that. That trailed the ACWI, the whole world index, but that number handily beats most of the other non-U.S. indices over time. So again, good for us. We did well in our non-U.S. Marketable alternatives, that's what we call our bucket of hedge funds and private credit. It's a different kind of bucket. Not a lot of equity actually in that piece of the portfolio. Returned about 6.6%. It was really right in line with its component of the benchmark. It was, I think, I beat it by a little bit, but nothing hugely material. So right in line. So the one in yellow, obviously, that's why I put it in yellow. That's the important one. So on a 1-year basis, the private equity and venture capital component of our portfolio, which is about 19%, give or take a few basis points, was basically flat for the year for 2023. So the public markets, the S&P is up 27, the ACWI is up 22. Our private equity portfolio was slightly positive, but it was basically flat for the year. Now, in our benchmarking, we benchmark the private equity portfolio to the public benchmark, the ACWI portfolio. That's up 22. Our private equity portfolio is flat, and therein is the 2.5% difference. That's basically all of it right there. Now, so then you might say, gee, how come we're invested in this stuff if it did so poorly last year? Well, that's what the numbers going off to the right-hand side try to illustrate. Look at these 3-year numbers for private. And this, by the way, is including a miserable 2022 and a pretty miserable 2023, right? We made money in 23, but it's hard to count it. It didn't, not a lot. So, but look at these 3, 5, 10-year and since inception numbers. The 3-year number for private equity and venture, let's call it 8.8% positive. That beats all these other asset classes, by the way. The 5-year number, again, you can see the math pretty quickly, 15.8%. The 10-year number, 13.85%. And since inception, 12.8%. That's what this asset class, this collection of assets in private equity and venture capital has done. So if you just remember back to that chart where I showed you the asset growth, the cumulative investment return, what was driving a lot of that was the juice there was a lot of this PE and venture capital portfolio. So we reaped the benefits of this portfolio for at least a decade. Good for us, right? That was terrific. Now feeling some downside pain here as that whole market, private equity and venture capital, is kind of frozen up. That started in 2022, continued in 2023. I don't expect it to rapidly sort of thaw out. It will get better. as the unfortunately didn't catch up to the public markets this year. It will get better, but last year, candidly, was very lackluster. So that's the explanation. That's that 2.5% gap between our performance and our benchmark performance. Thank you, Leanna. Great. So how are we invested? This is the asset allocation. This is how we divide up the pie. Fortunately, we've got pie charts, so it makes it even easier. Asset allocation as of the end of year 2023. On the right-hand side, the pie chart shows our target allocation. This is kind of the ideal world, sort of the platonic ideal, if you will, of the portfolio that we're thinking about, the target. And it should be pretty clear. On the far right, the half moon on that pie, 50%, we call it listed global equity. That's public equity, stocks. The yellow piece of pie is fixed income. The orange piece of pie is private equity and venture capital. Hold on to this image. And then the light blue piece is hedge funds. So that's our target allocation, 50% to stocks, 25% to hedge funds, 10% to private equity, 15% to fixed income. So that's the ideal. Now let's look at the reality. At the end of 2023, what did it look like? We were 42.5% in stocks, so we were underweight our target of 50. We were 21% in marketable alternatives, a little bit underweight also our target there. We were 19% in private equity and venture capital. Now, hold on to this, because you see in the target, we should be at 10, we're at 19. This is a function of what happened during 2022. So we are overweight private equity and venture capital right now. So not only did private equity and venture capital thoroughly undistinguish itself last year, we are overweight our target in that asset class. We are right at target with, well, I guess we're 10 basis points over. We're a smidge over target with our fixed income and cash. That's the yellow piece. And then we have a sliver of real assets. This is a legacy piece of the portfolio that is winding down now. It's a very small piece of the portfolio. It's private equity and natural resources, and it's winding down. That number will slowly get smaller as we continue. So that's how we're invested. That's the target, and that's the reality. Thank you. What did we do in 2023? How are we invested? Our portfolio adjustments in 2023. Well, one thing we did, now that rates are a little higher, you can make some money in fixed income again. It's been a while. And so we increased our fixed income allocation to target. We had been underweight for quite some time in fixed income before my arrival here. And that served us very, very well in a very low rate environment. And then in 2022, you may remember we were talking at this time last year, and I was talking about how crazy 2022 was, in that both the equity and the bond markets went down, which happens very, very rarely. Being underweight bonds in 2022 really helped us. But now it's time to get back to target. So we increased our fixed income allocation back up to 15% from being underweight. In our public equity book, we did something important. We increased our liquidity and we reduced our investment expense. The amount of money that we pay our investment managers, we reduced that. How do we do that? We shifted some of our public equity exposure to passive index vehicles. So now we have a mix of active managers and passive indices. We did this especially in U.S. equities. So it meant leaving some active managers that we had been with for quite some time and reallocating that capital into passive exposure. So we did that move. And again, pulling down the expense structure of the portfolio. And it has the side benefit also of increasing. We have plenty of liquidity in the portfolio, but it increases our liquidity even more. We continue to decrease our direct China exposure. In the public equity market, we have very, very little left of our China exposure. It's down to basis points at this point. We continue to have some private equity exposure to China. In the spring of 2023, we added some global macro exposure in the hedge fund portfolio. It's a strategy that we did not have, and we added some of that to the hedge fund portfolio. And we'll hopefully continue to see that begin working better as we move forward. And the thing one of the things that I'm most excited about is that we added investments in Maine, Maine-focused investments, money in the ground. I'm still trying to find the best phrase to explain it. Money in the ground in Maine. I'll talk about that a little bit later, but really excited about that piece of our investment portfolio. So how are we invested? Sticking with this question. We have a statement of responsible investing that commits us to partnering with investment managers that take ESG factors seriously, integrate them or consider them in their investment process, as well as DEI. So all but one of our active managers considers or integrates ESG into their investment process. When we think about DEI in the portfolio, how can we reflect our values about diversity, equity, and inclusion in the investment program? 4 of our 27 investment managers are owned by BIPOC individuals and or women. And in fact, the second largest position in the portfolio, that's correct, the second largest position in the whole portfolio is owned by a woman, and upper management is all BIPOC. We added 1 new manager here in 2023, and we are literally, the ink hasn't dried on the paperwork right now that we're finishing up as we add another one. Hopefully we'll get that in the portfolio by the end of the month. I guess at a high level, what I'll tell you is that we continue to see DEI progress in operations, client services, and in investment analysis roles all over Wall Street. I think that's a given. The challenge is at the partner level or the portfolio manager level or the owner level, it's a lot slower and not as much. So I'm constantly searching for those firms and those strategies with those people that are running them. And we will continue on that search, and we will continue to diversify our roster of investment managers. Okay, Maine-focused investment opportunities. I'm really excited about this. In June of 2023, the investment committee approved and the board adopted this idea that we would dedicate 2% of the primary pool to investments right here in the state of Maine. At today's value, that's $14 million, give or take a little bit. We've made 3 investments so far that totals about $8 million. I've got 1 more in my sights right now for 2024. What are the 3 that we did? $6 million in a solar infrastructure fund that's got 35% of its projects in 6 different counties in our state. $1.5 million commitment to a small venture capital fund called Bold Ocean Ventures, which is a joint venture between some real veteran venture capital investors here in Maine and Gulf of Maine Research Institute. It's going to focus on climate change-oriented technology. There's a whole field of activity called blue ocean technology and investing. Sadly, the Gulf of Maine is one of the fastest warming bodies of water on the planet. The good news is that's the bad news. The good news is that it's attracting a lot of international attention as scientists from all over the globe are studying it, want to be here, are studying it. That in turn is generating a lot of innovation, a lot of entrepreneurial activity. Think about what's going on at the Reay Institute. Think about what the Maine Venture Fund has been doing with the Reay Institute. Lots of activity, lots of energy around this. And this joint venture with VC investors and Gulf of Maine Research Institute is tapping right into that and really exemplifies that kind of energy. We want to be there. We want to support that. And I believe that it's going to be a terrific investment. It's small, but we've committed $1.5 million there. And lastly, this just happened very recently, $630,000. So a small but really important linchpin kind of investment in a sustainable timber project near Greenville. Got a lot of press in January and late December. Really excited about this. Sustainable timber meets conservation. Really excited about it. That money's in the ground. It's already working, and we're off to the races. Now, one of the things that you might notice is that all 3 of these things have a climate element to them. Our intention was really to put money in the ground in Maine. It didn't have to be climate. Turns out that there's a lot of activity going on around climate-related investing going on in Maine. So these are the three best ideas that I have, and they happen to be in climate. It doesn't mean that everything we're going to do is going to be in climate. The next idea that I'm looking at may not have that same kind of focus. More importantly, it's money in the ground in our state. And so this is what I would like to emphasize. First of all, these investments are terrific investments. They are right here in our state. And when I think about it from your point of view, your dollars that you've entrusted to us, not only are you using them to further your mission or to further your charitable impact that you have in the state, but those dollars are also getting recycled in some sense back into the state in terms of jobs, in terms of projects, in terms of what's going on. So your money is being invested right here in Maine. I don't know of any other organization that can say that. And I'm just really proud and pleased with what it is that we're doing on this front. And there's more to come. You can see we've set aside 2%. As that primary pool gets bigger, obviously 2% gets bigger too. So let's hope for that. And so far we've put about $8 million in the ground. So really excited about that. Outlook for 2024. Let me tell you a few things that we're thinking about. So first of all, in general, and I suspect if you've been on these calls before, you've been here a while, you already know this, but it always bears repeating. We're not an aggressive swing the portfolio around kind of organization or investment program like you may read about hedge funds that are doing this and selling that. And, if you ever watch Trading Places, buying pork bellies and selling orange juice. And we're not day to day moving a lot of things around. We're not traders. This is not a trading portfolio. The investment committee meets 4 times a year. That's when we all gather, and that's when most of these longer term, bigger decisions are debated and take place if we implement anything in the portfolio. And the investment committee does have the ability to get together in a crisis and talk about, hey, is there something that we need to act on with the portfolio? The last time that happened was COVID. The last time major action was taken was in response to the big drop off that happened in the equity markets when COVID broke out. We have met since then in other contexts when the Ukraine war broke out, for example, got together immediately. Hey, is there anything we need to think about the portfolio? The answer was no. The portfolio it's an all-weather portfolio. It's terrific. But my point is that the committee can get together on demand as necessary. We're cautiously optimistic. I think at this time last year we were cautiously pessimistic. It seemed like the risk of recession was much greater. We're cautiously optimistic now. The economy has been, and I think pretty remarkably, has been very resilient in a higher rate environment. And the Fed so far seems to be doing a terrific job navigating this kind of Scylla and Charybdis of inflation and rates and economic growth. So things have been going pretty well, and I think that's typically what you'll see in the media. I will say this though: the typical indicators for a recession are still there. The lights are still blinking. It's not like it's just all unicorns and butterflies. The signals are still blinking about the yield curve. Credit card debt is peaking. There's all kinds of things that are going on that are not terrific. So the possibility of a recession is still real. I don't think it's as great as it was before, but it's still around. Look, there's also geopolitical shocks. We saw this last year, the war in Ukraine, the war in the Middle East. This year adds some election turmoil into that here in the U.S., but also 49% of the polities, the political, not organizations, I'll say polities around the world, 49% are having major elections this year. So there's a lot of elections happening around the globe, a lot of opportunity for change, a lot of opportunity for turbulence in the environment, and of course, all eyes are here watching the U.S. to see what happens. So that could be an impact on the environment. And as I mentioned before, the investment committee is prepared to respond if we feel like there's anything that needs to be addressed specifically in the portfolio, either to protect or to take advantage of some kind of a situation. So what does the portfolio look like now? This goes back a little bit to that pie chart that you might remember at the end of December. Kind of this is a verbal explanation of that situation. So where are we right now? We're a little bit underweight public equities. You may remember at the end of December, it was about 42.5%. We're not expecting a rapid recovery in private equity and venture capital. We feel that these are across the board excellent investments. We are going to make a lot of money in these investments. They're frozen up a little bit right now. Frozen up a fair bit right now. But we're not going to sell in the secondary market where you can go out and sell at a big discount. We're not interested in that. We like what we own, but we don't expect a rapid recovery here. Do expect to incrementally add to public equities with excess cash if and when we have it, to keep our exposure on in the public markets, to address that underweight and see if we can keep that not being too much under. And I expect to add to some Maine-focused investments as the year goes on. We're at target in fixed income. I expect that we will remain there. And we're also looking at some new hedge fund ideas, especially in long-short equity. I think, is that, next slide, Leanna? So the big, increase the point size as big as I could so I could read it. So look, the conclusion is, again, thank you for your support, your partnership. And we are and we will remain a long-term investor, all-weather, safeguarding and growing the assets that you've entrusted to us. So thank you very much for your partnership. I am always available to talk, answer questions, be as transparent as humanly possible. I know that Leanna and Becca feel the same way, so you're more than welcome to reach out to any of us, even by postcard. There's our address. If you can't find me on the phone, you can shoot us a postcard. Thank you.
Brendon, we did have a couple questions, a couple of which I think I can answer. One was about the presentation materials. And I should have mentioned earlier that we will make these available. So those that registered for the webinar will get a copy of this presentation. We'll also be putting it on our website along with a recording of the webinar so that you can look through these later. And I'll add that in addition to the material you've seen here today, there are a few more slides that not only list out the members of our investment committee and a little bit about our investment consultants. Recall that's the process we use. Brendon leads that team, but he works in conjunction with the investment committee and Monticello to make these investment decisions on behalf of our fund holders. And then there's also some slides in here that's just general information on the Community Foundation, some year-end summary on grant making and types of funds that we manage. So that will all be there for reference. One of the other questions we got was, and we do get asked this frequently, it was about the timing of our quarterly reports. So, recall that we post all of this investment activity on a quarterly basis. And so most of you, I'm sure, are aware of that and know that our fund statements are available online for you to download. Unfortunately, because of the multitude of investment managers that we work with, it does take about 2 to 3 weeks to reconcile all of those various accounts and get that net investment return posted to the fund holders. So as much as we'd like to be able to expedite that, it will really take us till the mid to end of the month following quarter end to have that material ready for you. Brendon, I don't know if you want to elaborate on that, but we're always happy to sort of share some highlights about what's been going on the investment side month to month. We do have that information available, but as far as the hard numbers in your quarter end balances, that will remain towards the end of the following month.
Yeah, nothing. So thanks for reminding me, Leanna, about those further slides at the end of the presentation. Please do, if you have a chance to look at the presentation, there's some interesting data about grant making. I'll just give you one number that always sticks in my head. Over the last 5 years, $275 million of grants have gone out from the Maine Community Foundation supporting our communities here in the state. So that kind of data is there. So if you're curious about it, please do take a look. Yeah, and on the statements, this is a little bit of this is one of the kind of bugaboos about having some of these different sorts of investments that we have, is that they're a little slower to valuations are a little bit slower. And in fact, some of the private equity stuff tends to lag even further behind. We're always paying attention to it and always catching up and figuring it all out. So it's not something you have to think about or worry about, but there's definitely not a real-time aspect to this portfolio. Now, as Leanna mentioned, always happy to talk. And I mean that sincerely. You can pick up the phone and call me, and If I'm not in a meeting or doing something, I'm more than happy to talk about what's going on and give you a feel for what it is that we're doing and thinking and seeing. So please don't hesitate to reach out.
We also had a question about the Genesis Fund, and I know this has been a work in progress, so I'm not sure if we have much to share at this point. But as many know, Genesis is a leader in Maine supporting workforce housing development. And Maine Community Foundation understands that housing is a significant issue for Maine, especially for BIPOC people. The question is really, what is the current thinking about investing with the Genesis Fund?
Good question. I don't have a very satisfying answer for you. I mean, right now we are not invested with the Genesis Fund, and it's going to depend on the degree to which the foundation gets involved in housing or workforce housing development at a strategic level, and I just can't be very concrete about that at the moment. So not a very satisfying answer, I know, and I'm sorry. So we're not there now. Have a huge regard and very high regard for the folks at Genesis, and would love to be able to work with them, but nothing immediate right now.
We also had a question about the spending policy. Is it still 4%? The answer is yes, but Brendon, I don't know if you want to elaborate on how we arrive at the 4%.
No, I don't have a whole lot to add. It still is 4%. You know, the way we think about the math problem, if you will, of the portfolio, to keep it very simple, when you think about what does the portfolio need to earn, what's our bogey? The number is spending policy plus, from your point of view, we think about your administrative fee, right? Spending policy plus administrative fee plus inflation. What are can't control inflation, and everyone can talk about what that number should be. Typically, since inception, that number has been right around 2.5, 2.6% for inflation. In my head, I tend to use 3 because I like round numbers. It just makes the math easier, although I get it, it's not that complicated. But anyway, 2.5 to 3%. We keep that spending policy at 4. The reality of the spending of all of our partners is that it's higher, but the policy is 4. No intention to change that. Anyway, that's the math problem, if you will.
And then we also had a question about our nonprofit endowment funds, or what we refer to as our agency fund partners. Those are other nonprofit organizations that are investing their own assets through the Community Foundation. And the question was, are those funds invested at MaineCF alongside with other investments? And forgive me if I'm reading this question incorrectly, certainly happy to follow up later. But the short answer is yes. Our agency fund partners are invested the exact same way as our donor advised funds, our competitive grant making funds, our scholarship funds. The vast majority of all of these different types of relationships we have are pooled into this one primary investment portfolio and managed the exact same way. So Brendon,
Leanna, you can scroll down to if you can scroll down to slide 24, that's what it shows. When we were referring to additional slides in the presentation, there you go. That's what Leanna was just referring to. So this is my favorite, pizza chart, big pie chart. And this shows you the relative amounts and percentages of the different kinds of funds. So our agency fund partners there that Leanna mentioned, 20%, our donor advised funds, 36%. That's largely what Becca was referring to. But then you can see all these other things, and that's the whole pie. They are all in the bucket. Thank you, Leanna.
Also had someone curious about, you had mentioned considering some new hedge fund ideas. I'm wondering if you wanted to elaborate there at all.
Sure, happy to talk about that. The hedge fund book right now is largely credit. There's some equity exposure in the hedge fund bucket, but it's largely credit. And we have a global macro manager as well, which trades all kinds of things: equities, bonds, interest rates, commodities, currencies, the whole shooting match. But I don't think we don't have a lot of equity exposure there. And so long short equity, now that interest rates have gone back up, without getting too technical, I don't want to bore you with the details, but low interest rates, it's difficult in a market from 2009 basically until 2022, this massive sort of beta fueled expansion of the market, this gigantic bull market that we've been in, zero interest rates. First of all, it's really difficult to make money shorting stocks because everything goes up. And very difficult. If you're shorting, you tend to get smoked more often than not. So very difficult to short. And then with a zero interest rate environment, you're not getting any money on the what's called the short rebate. So with now that rates are up, one of the things that low rates, the ability to borrow money very inexpensively can cover up some other sins, so to speak, in various businesses. When rates go up, some of those, it's not as easy. And so you tend to get a little bit more differentiation in the stock market, which is good for stock pickers, right? They should be able to say, hey, this is a good stock to own and this is a bad stock to own. And for the previous decade, sometimes being able to make that distinction was difficult. So at the risk of, sorry to be blathering on, long short equity is a space I think that's been a pretty tough neighborhood for quite a long time. And I think it's looking more and more attractive. And so that's an area that we're spending a lot of time looking around.
Okay. And also, would you, Brendon, like to talk at all about the investment management cost and considerations there?
Sure. Yeah, absolutely. I'll have to get back to you with the exact number of the investment manager cost. So one thing, I talked about this just a little bit earlier, one thing that we did with our investment manager cost was try to pull it down on the public equity side of the book, rotating out of some more expensive managers into not quite free, but pretty close to free index funds. So that's one way of pulling down that cost structure. Now, private equity and hedge funds are not cheap. The good news is they all have high watermarks, and so we don't when they go down, we don't pay them an incentive fee or what's called a carry or a performance fee until they get back up to that high watermark, and then they do get to share a piece of the profits as we go as we go forward. I'll say a couple of things. I mean, one is that sometimes those funds on the hedge fund side or the private equity side give us access to asset classes that we can't get in other kinds of more publicly traded vehicles that you can get at your brokerage house or whatever. So they can tend to be a little bit esoteric, and so potentially sources of differentiated alpha for the portfolio. But you have to pay up to be in that game. So there's that's a little bit of the trade-off. Now, in private equity and venture capital, we've seen over the long haul that that's really worked. The premium for locking up your money in more expensive vehicles has more than paid off. On the hedge fund side, it has too, less dramatically, and but those vehicles can be expensive. So I guess the summary here is that I am very mindful of the total investment cost of the portfolio, and we think that we can get the best and right investment results for cheaper, we're going to be leaning in that direction. And if we don't, then we won't.
Thank you. And I think our last question for today goes back to one of our favorite topics, the Maine focused investments. And just, you mentioned 3 that we're currently working with and a potential 4th one that you're considering. How about what's your process for selecting these investments?
Yeah, great question. Thank you. So the first entry point into these Maine-focused investments is through a fund vehicle. So the first cut is looking at, can we find investment managers, just like we do in the portfolio for emerging markets or stocks or all these other sorts of things. Can we find third-party investment managers who are investing in investments here in the state of Maine? As you might imagine, it's not like there's a lot of those funds that are doing either a significant amount or 100% of their investing in the state of Maine. So that's our first approach to it. Then you say to yourself, gee, well, if there's not a lot, then what are you going to do? Well, so the next step would be, imagine if what an investment fund manager does, right, is they go out and they source and they underwrite different investments. They're going to invest, so many dollars over here this ice cream stand, and they're going to do it over here and this, and they're going to do this and that the next thing. We don't do that. We're not direct investors. We don't have the ability to underwrite direct investments. For me to say, I think this is a great idea. I think we should invest $5 million in that. And making that sort of direct connection. We don't have the capability to do that. So that's why the initial investments have been at the fund level, and that's where they're going to stay for now. I hope and let me add, then those funds, we do thorough due diligence, we bring in some third-party experts, we do legal review, we do all the due diligence that we do on these kinds of investments to make sure that, you know, it's not a bunch of knuckleheads doing this, that, or the next thing. We want to make sure that they're good investments. So, so we do all that before we actually take it to the investment committee and say, hey, this is a really terrific idea and we want to do this. But keep in mind that it stays at the fund level. I hope that gets at your question. If not, feel free to call me and I'll try to elaborate more about that.
All right. Well, that kind of clears our questions. Certainly, as Brendon said, reach out to any of us if you think of something later or would like to talk further about some of the work that we're doing at the Community Foundation. But on behalf of Brenda and Becca, thank you very much for joining us here today. We really appreciate your partnership with the Community Foundation and hope you get to enjoy the rest of the afternoon.